Okay. So hi to everybody that's on. We are not going to go according to the agenda that was actually put out. This is just going to be we're going to waive the approval of the minutes until our next meeting in April, which will be held in person, and it will be our pizza party finally. We're going to skip right to number 4, master deeds. Just letting all presidents know, I'm sure you already do, but we're just going to reiterate it because someone did have a question on the master deeds. The CCA does not have a master deed. The only people that have master deeds are the sections. Each section has its own master deed. And whatever's in your master deed, those are your rules, your bylaws, that's it. The CCA has rules and regulations, but they do not have a master deed. So we just wanted to get that out of the way. Number 5, Steve has some issues on parking.
Yeah, just very briefly, I sent all the president's parking section from our new rules and regulations with some things highlighted. If anybody else wants it that doesn't have it, let me know. I'll send it to you. In any case, we're having a problem in Section 6 with parking, and we would really like the rules enforced. Unfortunately, it seems that Arrow doesn't always have a nighttime rover, so violations are not given out routinely. So we've taken matters into our own hands, and we've been watching and we've been reporting violations to administration. Now, this slows the process down some, but we've had some success. So I would just like to ask all the presidents, ask all the section boards to consider doing the same, to enforce the parking rules. And if you see something that's not right, send a note to administration and get the ball rolling. Thanks in advance. And with that, I guess we would turn it over to our attorney, Dave Ramsey, or Donna wants to do that. Donna, you want to do that?
No, I just wanted to explain a little bit about a webinar. I know most people have been on webinars in the past. Webinars do not allow the attendees to speak. So any questions that you have, please put in the chat. I will look at the chat as Dave goes through and Dan Rush goes through their presentations. And then at the end, we'll take all the questions for each of the panelists and we will ask them one at a time. So this is Dave Ramsey. He's from Becker and Polyakoff. He is the best attorney in the entire world. He helps us a lot, and he's going to say, well, Dave, which part are you doing?
Well, we're really focusing on reserves tonight because building integrity really doesn't apply in Clearbrook. So we're really focusing on reserves, and that's what I'm going to be going through. Dan is looking for the link, Donna, by the way. He sent me an email.
I'm trying to allow him in promote him to a panelist, but it's not letting. Oh, here he comes.
Here he comes. Here he comes.
Dave, I thought you were going to talk about the Corporate Transparency Act.
Oh, you want this just on? Well, I didn't know why.
No,
Dan
I think it's the both. You both are going to talk about reserves together. Then we're going to do corporate transparency.
Okay.
Yeah.
Okay, good.
So let's start with reserves. And Dan, hi.
Hello, everyone.
Hi, Dan.
Hey, Dan.
And I'm going to share my screen so we can run through this slideshow. And can you see it?
No.
No.
All right. Bear with me 1 second then. Just took up my whole screen. Got to reduce it. Okay. Let me go back to share screen. Host disable participant screen sharing.
Not
Donna.
sure. Hold on. Try now. Try now.
Try now. All right. Let me give it a shot. Now I can see my screen. All right. Let's go here. Share.
There we go.
There we go.
All right. So now let me go into slideshow from there. Now, are you seeing the main screen or the other screen? I can flip-flop them.
I think the main slideshow we're saying building integrity reserves.
Good. Okay, so you're seeing the right thing. Okay, so for all you members who are attending, first of all, thank you very much for attending. Happy that, you're interested in learning a little bit more about this. And even though the title slide says building integrity and reserves, because the statute adopted on January 8th of this year deals with both issues, your buildings are not covered buildings under the building integrity section of the law. So the good news is you don't have to worry about that section. The only section you're going to need to worry about are the reserves sections. So we're going to go through that, Dan and I, and kind of take you through what we're talking about here. So the law on capital reserves, and by the way, one of the main reasons that this law was adopted is because we were seeking to eliminate special assessments and loans for capital replacements and repairs. Too often, associations didn't have adequate amounts of funding, and then they would be forced to either specially assess or go out and get a loan. That's not good planning. The whole purpose of a reserve study is to be a budget tool and to assist the board in planning for future repairs and replacements. So one of the first things it says, and Dan, please jump in at any point that you like to.
Okay.
It says that you must, if you haven't had a study within 5 years, you have 1 year to obtain it. All reserve studies must be performed by a reserve specialist or a licensed engineer or architect. The study must be in accordance with CAI's reserve study guidelines. Plus, there's some additional legislative criteria. For instance, the anticipated costs associated with building maintenance. We typically would have talked about that, and the next bullet point, cost of corrective maintenance. We would have talked about that as deferred maintenance in the past, but now it's all grouped into reserves. So if you do have a deferred maintenance account, you can consider both the balance in that account and the balance in your reserve account as being covered by this law. Then costs of future reserve studies have to be included. And the last bullet there you can ignore because you're not going to have any periodic structural inspections.
David,
Go ahead, Dan.
my one addition on the previous slide would be to the folks that it says you can have a reserve specialist prepare the reserve study or a licensed architect or engineer. I want to just let everyone know, for instance, this law deals with structural engineering. So every structural engineer is a civil engineer, but not every civil engineer is a structural engineer. That also applies to the reserve studies. So, if you use a reserve specialist, you're covered. They're certified in exactly reserve studies. But if you go to an architect or you go to an engineer, just make sure you ask them if they have experience with reserve funding. I'll be the first to say that reserve funding isn't really high-level physics or rocket science or brain surgery, but I've been doing it for a long time. There's definitely a skill set involved, and experience is a big part of that skill set. So just when you do go out to anybody to do your studies, just make sure they've done a couple, maybe more than a couple. You don't want to be their guinea pig because, this new law comes at a time where we're seeing really high construction inflation. We're kind of getting hit on both sides. So you're really, with the time constraints, you don't want to have someone do an inaccurate study or a study that really doesn't suit your needs. Thanks.
And if you did decide to go to somebody other than a reserve specialist, you have to make sure they're going to be following the statutory standards and CAI's reserve study standards. I think there's a lot of people out there who think they can do reserve studies, but unless they're following those standards, they're not doing it the right way. So one of the things, how did I skip so far ahead? Actually, this slide ended up being in here. It's really part of the structural integrity. Whoop, what happened there? Sorry about that. I just must have skipped ahead by mistake. All right, let's do this one more time. Okay, so part of the law says, hey, if you have deficiencies In other words, you haven't been reserving in accordance with your reserve study, your most recent reserve study, or you've been using reserve funds for operating. And sometimes that happens because unanticipated things do happen during the course of a year, and you only have so many places you can get the money from to pay for those unexpected operating expenses. If you were using reserve funds for that and then not replenishing those reserve funds in the next budget cycle, you may well have a deficiency. If you have a deficiency, first thing you can do is choose whatever funding plan you want. The statute doesn't state with any certainty as to what funding plan you must choose. And Dan, because you deal with this every day, you want to tell everybody what funding plans are?
Yeah, absolutely. So when we talk about reserve studies, there's various funding plans associations can adopt based, I would say, based on the risk that they're willing to be comfortable with. So the most conservative reserve study methodology is called component or full funding. That's where you're going to match the depreciation of the common element every year. The example I always give is if roads last 20 years, we put 5% of the money away every year. At the end of 20 years, we have 100% of the funding. One of the things that makes full funding very conservative is it doesn't look at the entire list of common elements. It almost does a little individual reserve study for each line item. So you're funding you really don't have different accounts, but you almost have a different account for each item in your reserve study. But then there's other methods which aren't as conservative, and those methods are called the pooling methods or the threshold method. Pooling method because unlike what I just said, all the money gets put into one bucket, and as you need to do the replacements, you go into that bucket. I think the bucket's in Donna's closet, by the way, everybody. But I think you go into that bucket and you will take the money out as you need it. So that's also called threshold funding because at the end of the day, we always leave well, in some of the methods, we leave a threshold or a buffer or a safety net in your finances, an amount of money that isn't allocated because things tend to be more expensive than maybe we anticipate, maybe useful lives. We don't, maybe the roads don't hold up as long as we would like them to. Maybe there's extra work when you go to do the project and we peel back some shingles, we find some bad plywood. So there's always reasons where we go a little above what we allocated in the reserve fund. So the threshold funding is a cash flow method. It's like your checkbook, right? We don't write checks unless we have money in the bank. So as engineers, as reserve specialists, we figure out what you're going to need, and then we never let you get below zero. In threshold funding, we always keep that safety net. So the threshold or the how big of a safety net you want to pick is called the threshold. So we would use 10% threshold funding. We would use 5%, meaning we would keep 10% of the value of your common elements in the bank. A little less conservative would be 5%. You would keep 5% of the value of your assets. And then there's also another methodology called baseline funding, which is the same methodology as threshold and pooling funding, but baseline means we take you down to zero. There will be a year in the 30-year study where you actually go down to zero. There could even be a couple years where you might go down to zero. So obviously that's very risky. We'll talk about the law and you'll see where it gets even riskier with the new law. It will make for you to jump through more hoops. As an engineer, obviously, we would love you to be more conservative so that you can replace these things. You know, David mentioned you can borrow money or you could do assessments to get the funds needed for an individual replacement. Well, there's a third option, which no one recommends, which is you defer the work. And so I want to say that that's not acceptable either, because your engineer saw a reason to put a useful life or to say you needed that project. So that's a third option we won't go into, but we don't want to push the work down the road. It gets more expensive. In certain items, you could obviously have some safety issues. But those are the three methodologies. Full funding is not used by all that many communities because it is so conservative and results in a higher contribution. The threshold funding are probably 90% of the studies that I do. And then what we can do as we move forward to tackle these new requirements, we can adjust that threshold, that 10 or that 5%. Who knows? You might not like either. You might like 4.5%. We can do that too. It's just a matter of the amount of risk that you want to be comfortable with.
Thanks, Dan. I appreciate that. And obviously, as Dan was indicating, the lower the threshold, the lower your contribution. Now, also, the higher the risk, as Dan already indicated. But if you have, one of the options, if you have a deficiency in your account, is to lower your threshold, whether that's going from 10 to 7.5 or 7.5 to 5%. And what we're talking about, because I think people don't fully comprehend this, if you had $1 million worth of asset and you had a 10% threshold, that means you're projecting you're never going to go below $100,000. If you have 5% threshold, you're projecting you're never going to go below $500,000. So I'm sorry, $50,000. Excuse me. So that's the cushion. That's the extra money that you are projecting you will have in case anything doesn't turn out the way you expected it to. But you can temporarily go to a lower funding plan if it's necessary, because that will also lower your deficiency. Let's say the last study you had, you said, okay, we're gonna fund it 10%, but you really didn't fund it 10%. As years went by, you funded at some lower number. Well, if you lower your threshold from 10 to 5, you may be much closer to being completely funded in accordance with a 5% threshold. So that just gives you some thoughts about there are options available to you when you have a deficiency. There are options. And while neither Dan nor I would recommend baseline funding because of the risk, if you had to go there for a couple of years while you were catching up, while you were trying to get your funds back into proper amounts, you could do that and then go back to later 5 or 10% threshold funding. So you're not stuck with it forever just because at one point you pick one level of funding. Okay. By the way, I should back up 1 second. Man, oh man, I don't know why this is jumping around like it is. It's just kind of crazy. Sorry for that. It shouldn't be. Man. Okay, we did that. Okay, we actually skipped this slide. One of the things you have to do, though, once you get the study, you have to fund in accordance with the study. So the law is no longer allowing associations not to budget for the amount in the study. Part of the reason is you're fiduciaries. You have a duty to take care of the property and money of other owners. One of your fiduciary obligations is to make sure that the common elements are properly maintained. The Condominium Act says that boards must properly maintain, replace, repair, and keep sanitary the common elements. There's really no choice in this. Now, despite the fact that there's no real choice, we know that over the years, some associations, not all, some associations have let that slide. And when that slides, the likelihood of what's going to happen is the housing stock in your community is going to degrade. Because when you don't do those repairs when they need to be done, what happens? It gets worse. So if you have roofs that are leaking and you don't replace them and water is pouring through, as Dan mentioned before, the sheathing underneath the shingles are suddenly going to need to be replaced. Maybe the rafters have gotten wet and they've started to decay. the costs can spiral upwards dramatically if you don't do this on a timely basis. Now, if you didn't do the alternatives we just talked about, oh God.
Dave,
Yeah.
you want to answer any questions in the middle of your?
If it's
What do you want-
relevant to what we're talking about at the moment, sure.
Okay. Well, one is, what's the acceptable threshold? It sounds like you can change based upon what you need at a given point. It seems confusing.
Dan, do you want to tackle that?
Sure. So I don't believe Dave and I are trying to give you tricks to beat this law. I don't want it to come across like that. So what's the reason for this law, folks? We got to take care of our buildings. And the more risk we take with the threshold funding, the more likely we're pushing the can down the road, which is exactly what this law is intended to prevent, and prevent the need for loans and assessments. So number one, I don't want you to think the threshold is just a little willy-nilly and we can do what we want, because your reserve study provider will probably have an opinion on what you should do and will state that opinion to you. My personal opinion is, I don't think smaller communities should go below 10%. And my rationale for that is, if you only have a certain number of units, you probably can't raise funds that you may need quickly. Whereas with a community like Clearbrook with over X amount of units, let's say I'm talking about the Master Association, we do go down to 5%, because if we were to get in trouble, we're not going to hit people for a $50,000 assessment. We're going to hit them for $25 or $50 times the number of units, and you can generate some money pretty quickly. Now, that is something that I've developed, as my opinion, working with accountants, other reserve specialists, lawyers, and things. People might have a different take on that, but it's usually a 5 or 10%. I haven't done any studies where I've gone down to 4.5%, even though I mentioned that. What I think might happen, and the reason Dave and I are talking about these options, is we do have a time constraint with this law. So possibly to get you out of trouble in the next few years, as you assess your reserves and get yourself in a good place, there are some options, okay? It's not the absolute end of any kind of discussion. Nobody's going to force you. There are some options, but generally we want to follow the standards that have been created by reserve specialists, and a 5% is usually a minimum. And then for communities with 30 units or 50 units, I generally don't go below 10%, because I want that safety net to be there when they need to get the work done. So it is variable. We do get to select it. But there are some industry standards, let's say, on what's normal and expected. Now, this is new for me. This is new for Dave. I mean, Dave wrote a lot, contributed to it, so he knows a lot about it a little longer than some people. But the industry is going to adapt to this and learn and adjust. And so I will have to see what happens with the thresholds. But generally, it's 5 or 10%. Again, the lower you go, the more risk that you have. I hope I answered that gentleman's question.
Yeah, I mean, I think the question was, what do you recommend? And the recommended is not less than 5, preferably 10. So
right, and in a perfect world, I still haven't found that world yet, we would love you guys to do full funding, because then you're always gonna have that money available. But I don't think I'd have a lot of business if I stuck to my guns with that. So
yeah,
we want you to be as conservative as possible. If anything, folks, the pandemic and the supply chain issues and the incredible inflation that we saw is the exact reason why we don't want to go down to zero. We need time to adjust to geopolitical events, economic turns, all those things. So it's really just like any kind of planning you would do for your household or your company. You want to be as conservative as you can while still put some profit in the bank at the end of the day. So we all have to make those decisions, and professionals like myself and Dave and Donna will guide you and give you scenarios depending on which way you want to go.
Now, let's say you had your reserve study. Let's just say you got it 3 years ago, and you only funded 50% I'm not saying any of you did that, but let's just take that as a hypothetical example. So let's say you were supposed to put away 50,000 a year. You only put away 25,000 a year for whatever reason. And that was 3 years ago. So you have 3 years where you underfunded by $25,000 per year. You have a $75,000 deficiency in your reserve account. So, but what the law does allow you to do is to look at that deficiency and say, okay, could I catch that up within 2 years without increasing the budget by more than 10%? If the answer is you could, then you have to catch it up in 2 years. If the answer is you can't do that without raising the budget by more than 10%, then you have up to 10 years to catch it up. Now, we will tell you in a minute why you will never get to the 10 years, but you can say, I'm just going to put away 10% of that deficiency. So in my hypothetical example, we had a deficiency of $75,000. You would divide that by 10, 7,500, and you'd start, first of all, you'd have to go up to the full amount that the engineer recommended in the report at whatever reserve plan you had elected. Then you take that full amount and you add to it the $7,500, which is the catch-up. However, as we explained, you can do some alternatives. Choose a different funding plan. Again, we're not recommending you go down to baseline, 0% threshold. There's no threshold with that. But you do have the option temporarily to go from 10% to 5% threshold funding. But maybe the best option of all is to get an updated report. Why is that the best option? Because when you get that updated report, it's going to take into account how much you currently have in your account, in your reserve fund, and it's now going to project going forward based on what's left in the fund. It's going to project going forward how much you need to put away to meet those obligations over the next 30 years. I have found in a number of associations that I've dealt with, that amount that you would now have to put away is less than what you would put away using the catch-up methodology. So it's actually an easier way to go about it. And, yes, you would have some expense related to the updated reserve study, but that expense is relatively insignificant. It's a relatively small amount of money. And that may be the best option that you have to move this forward. So that's definitely one tactic to take into account where you avoid the catch-up altogether.
And Dave, if I could add something, a lot of times us people with a genetic defect of being engineers, we think a certain way, and which is when it comes to putting a useful life, how long is that roof going to last? How long is that road going to last? By nature, I think we're relatively conservative, because when the road lasts longer than we say, our clients never call us up and complain too much. But when the road doesn't last as long as I say, I might get those calls. So when you, if you do have a deficiency and you're going to take the approach, well, let's do a new study. Added bonus may be, now not every time, folks, but a lot of times, if the roofs are not leaking and they still look pretty good, you may actually get some relief by extending the useful life of some items.
Great
Now,
point.
I'm not suggesting that the boards just extend the useful life of items without some engineering guidance. But if you're, if you're making repairs and you're keeping up with the maintenance, you can extend the life of certain items a little bit, and that can help you, manage these new requirements.
We have two questions that relate to this. One is there anything in the new law that changes the content or how any of the 3 different levels of reserve studies are done?
Well, I'll do the content side. There are some additional content requirements. We covered that in an earlier slide. And by the way, these slides can be made available to you. But it also requires that you pick up maintenance and corrective maintenance. So that, again, that's kind of like your deferred maintenance. The old painting that you might do on trim every so many years, or siding or doors or whatever, every so many years, that now becomes part of your capital reserve plan rather than in a separate deferred maintenance plan. So there are a couple of additional things there, but Dan, you want to comment on whether this changes anything about threshold funding?
No, it's there are, there are some provisions in the law we haven't talked about yet that will maybe affect some of the replacement costs that some reserve study preparers and some engineers use. We may get a little more conservative with the individual line item replacement cost, but I don't think it affects the funding methodology or how we're going to go about doing that. Adding the maintenance costs, the cost of a future reserve study to the study will have some impacts to the funding. In theory, if we're doing deferred maintenance right, we're just moving it from that one bucket in Donna's closet to the other bucket, and we should be good to go. So it will probably, in my experience, when you do your budget for your household and you write everything down and you total it up, you're like, oh, I can't believe we spend that much money. But now we're going to actually write down the maintenance you need to do, and we're going to put it in the reserve study. So there probably will be an increase in funding just because we're now allocating everything in the report, but it's not going to affect any of the funding methodology now.
Right.
Now, if you've had a reserve study done in the past 5 years, would you have to have a new one done?
You don't, but you may benefit by having a new reserve study done. So even though the existing study might not meet the standards of the current statute, you're okay as long as you had that reserve study done in the last 5 years. But as we've been pointing out, it may be your best avenue to fixing a deficiency you have in your account. Now, another thing I will say is we picked this 5-year interval in the statute. We picked it because it was the least onerous. But Dan, you want to comment on how often people really should do reserve studies given the current inflationary factors we're facing?
Sure. It's my opinion that I like a 3-year window to update your reserve studies, mostly because of what I just talked about with the construction inflation that we're seeing. There's probably some folks on the call. I've been very fortunate. I've worked for Clearbrook for a long time. There's probably some folks on the call or on the webinar that there was a period of time when there were some recessions. We were in between recessions or in recessions where replacement costs didn't change all that much. It was a great time. I remember, keeping the same roof numbers for 5-7 years because contractors just couldn't get anyone to pay anymore. So the market was kind of capped at those numbers. I think we're never going to see that again, at least not like that. So I think a 3-year window will capture everything. What I would say to the boards that have had a study within 2-3 years, so you have a couple more years until you have to update it, I would suggest you don't wait till the final deadline. You're going to want to have some time to adjust. You're going to want to have some time to work with your professionals. As I said earlier, we are adapting our reports and our presentations to encompass the requirements of this new law. So we're kind of learning a little bit as we go. So you just don't want to you don't want to paint yourself into a corner that you have to make some really quick decisions. You want to have some time. It's like when you do your budgets at the end of the year. We don't wait till December, right? We start in September, I hope. Same philosophy. I would just give yourself more time. As Dave said, fully recognizing I'm in the business of providing reserve studies when I answer this question. I don't think they're all that expensive for the value that you get out of them. So, if you're on the fence about a reserve study, I would always recommend updating it because I think you get some good information. And most importantly, you get some time to plan how you're going to conform with these requirements. So that's my answer.
No, and listen, coming from a profession where I don't make any money on reserve studies, I will tell you that I agree with what Dan said, that it does benefit you to more frequently update than every 5 years. You just don't want to dig a hole for yourself if you're in an inflationary period, and that would prevent you from doing it. Also, if you pick a level 2 study where the engineer is evaluating the condition of roof siding, etc., rather than a level 3 study, which is only an update in the costs of replacement, you're getting that opportunity to have the reserve specialist take a look and say, you know what? I projected your roads were going to last for, I'm picking a number, 18 years, but I think you're going to get another 2 years out of these roads. So we can kind of tail that one back a little bit because, you're going to have enough money for your roads. So that's another advantage of looking at it a little more often. Okay, so there's some limitations though that didn't previously exist in law, and this statute does provide. What we found from time to time is that some boards, when they had to, and I'll pick on roofs because it's the most easy example to pick on, when they had to replace the roofs, maybe because the price of oil went up and the price of shingles went up dramatically, maybe they said, oh, well, we have X number of dollars in our account. Now, I'm going to just pick a number. We have $1 million in our account to do roof replacements, but we just found out it's going to cost $1.3 million because the cost of shingles went up so much. And what some boards did was they just took that extra $300,000 out of the reserve account, never replenishing it. And what happens as a result of that? Somewhere down the line, there is going to be a hole of $300,000 in that reserve account. Recognizing that, the statute now says if you only have $1 million for roof replacement, that's what you should use. But if you can take the extra $300,000 out, you can borrow it. You're borrowing it from yourself. So you're not going out, you're not paying interest on a loan, you're not forcing a special assessment on the owners. But you can only do that if A, you adopt a resolution that says you're going to repay the money back into the account. That resolution says you're going to pay it back within a 5-year period. And that within that 5-year period, you're not going to prejudice the ability to pay for other projected repairs that are going to occur within that next 5 years. Now, let's say it would prejudice your ability to do repairs. Let's say you have to do sidewalk repairs, something of that nature, and you wouldn't have enough money for the sidewalk repairs, but you only have to do them in 3 years. Then you have 3 years to replenish that money back into the account. So it does give you some flexibility. It does allow you to take more money than is allocated for a particular item out of the reserve account. But when you do that, you need to have a plan to put that money back in. Dan, did you want to add anything to that?
And the higher the threshold, the more flexibility you're going to have to deal with that. So I mentioned earlier, you're going to see in a future slide where the threshold really comes into play, and this is it. The requirements of this law eliminate a lot of flexibility that we've had in the past with reserve studies. So keeping that threshold as high as you can afford is, I think, valuable and worth doing, because you'll maintain some flexibility instead of having to go through a process every time you do a reserve. Every time you do a capital replacement and you go over budget, you're going to have to look at your reserves. You're going to have to do a resolution. It'll become cumbersome. So I think that threshold, keeping that at 10% or higher, or whatever is good for your community, is going to be very important to manage this part of the law.
Absolutely. Okay. This actually wasn't, you thought there was another slide coming up, Dan? I'm sorry, on threshold funding. Did you want to, I don't see it here. Did you want to talk about that?
No, I was talking about a previous slide, Dave. I think we're good.
Oh, okay. So that's really that we've given you the basics of the law, and I think all of the important parts of the law we've gone through with you. I have no feel for, the individual sections and how many are funded up to the amount that they should be, how many have deficiencies, how many have significant deficiencies. Certainly for those board members who know they have significant deficiencies, you should talk to Dan or Donna or myself about what your alternatives are. This really requires, I think for the first time, boards to really do a deep dive on what reserve funding is about, what funding plans are about. And these are things as fiduciaries you should know and you should understand, because it has a dramatic impact. I mean, when you look at your overall budget, between the cost of routine maintenance that's in your operating account, reserves, landscaping, you're probably talking about, and snow removal, although we haven't had huge snow removal costs over the last several years, you're talking about those are the significant components. And the one thing you control to some degree in accordance with the statute is this reserve funding. So you really need to do a deep dive. If what we've gone over today isn't fully understandable, we can always provide you with some additional material to make it even clearer. So don't feel hesitant to reach out and get some additional information on this. Donna, do we have any additional questions?
I have 3 questions. What is the exact statute?
So the statute, there's an assembly version and a Senate version. The Senate version was S2760. Now, if you go on the legislative website, you can look at last year's session, because the session in which this was signed is the prior session. So you'd have to go to the 2022-23 session in the legislative website and then look for S2760, and you will find the law.
Okay, and then what is the average cost of a reserve study?
I would say the average cost of a reserve study is probably between $3,000 to $5,000. Probably 3 to 4 might be more of an average at Clearbrook.
How often should we be doing a physical reserve study rather than just an update?
Okay, so there's 2 kinds of updates. There's updates where we actually do an inspection, and then there's updates where we don't. So 3 categories of reserve studies real quick. Category 1 is a full study where we do everything. That's called a level 1 full study. A level 2 is an update with a site visit. So we do everything except measure the common elements. We don't think they grew since we did the last study, so we're going to go with those measurements. Now, I make a joke there. I always recommend my clients, after a few cycles for reserve studies, maybe to do a category 1 just to remeasure everything again, make sure no errors have been carried over. And then last category is a level 3. That's where we don't do an inspection. That's called an office update, because I don't leave my office to do the update. I update the useful lives and I update the replacement costs. So my personal opinion is level 3s are only about between $1,200 and maybe $1,800. They're pretty insignificant. I'm not a big fan. I really think you need to go out and look at these items. I'm a civil engineer. That's why I do this, right? We want to look at your roofs. We want to look at your roads. We want to see what's going on. But you could do a level 3 if you have if someone has been out to see your site within the last few years. I would certainly never go more than 1 update cycle without doing on-site inspections. I would have somebody put their eyes on your common elements at least every 5 years. My opinion of level 3s is they're good when you have a financial concern, when all of a sudden the insurance has gone up, or all of a sudden oil prices have gone up and 80% of your reserve study is roads. I think that's when you do a level 3. Otherwise, I really recommend you have your engineer, your reserve professional, put his eyes on the roofs, on the roads, on everything. You get much better return on your investment.
And I think the last one, Dave, is, and I know you explained this at the beginning, but why is the law changing?
Well, this is a new law, okay? Currently, so this all started out, and I would normally do this if I got into the building integrity part, right? This all started out with the collapse in Surfside. And the collapse in Surfside could be attributed to a lot of different factors. some of those factors included not doing work that needed to be done to the structural elements of the building, what we call the primary load-bearing system, not being kept up, partially because they didn't reserve adequate money to do that. So the structural integrity part, and again, you're not covered by that part, but if you were, that requires a structural engineer to come out, inspect your primary structural load-bearing system, and then to tell you if there are things that that engineer has observed that needs immediate attention. But there's also routine maintenance that you do that is necessary to the proper survival of a building. So as a result of Surfside, the statute came out with both the building integrity and the reserve side. It's well understood that in many situations, what has happened over the years is associations who do not fund properly. What ends up happening is they specially assess owners. What happens when owners get specially assessed? They get angry. And when they get angry, they push back on the board. And then the board gets a little nervous, and the board says, well, maybe we can push off this work for a couple of years. Or maybe the owners demand they go get another opinion. So now they have to go out and waste money on another opinion that is almost certainly going to end up in the same place as the first opinion. That's just a waste of time and money. And the worst part about that is when you're not doing that proper maintenance, when you're not doing that proper repair and replacement, you're multiplying the cost of the ultimate repair or replacement. So that just is degrading the housing stock in too many places in New Jersey. And actually, it was the legislature, it was Senator Singleton, who came to us and said, hey, we saw this situation in Florida. We have a lot of older buildings in New Jersey. I want to do something, and I want to work with you, CAI's Legislative Action Committee, to get this done. We said, we agree. We will work with you. Senator Greenstein, who is one of your senators in your district, also supported the bill. And we spent a lot of time explaining this to both assembly people and senators. And when they understood the total ramifications, they understood that there might be some short-term pain, financial pain, but in the long term, it's going to save associations money. The other thing that was grossly unfair is people would live in a community for years and years, not contribute the amount they should contribute to reserves, sell their unit, and then a couple of years later, that new buyer gets hit with a large special assessment, not because that buyer used up the common elements, the roof and so on, but because the seller never paid their share. This is going to force associations to reckon with that and make sure that the people who use up the common elements are paying for the common elements. So it's a matter of fairness, equity, and making sure that we keep costs under control by doing the things that need to be done when they need to be done.
Okay.
Okay, I know you want me to also go into the Corporate Transparency Act. I'm sure Dan, although he's welcome to stay, he probably doesn't need to hear.
Dave, I would stay, but I see that this is being recorded, so I'll catch up on it at another time.
Okay.
Dan, thank you.
Thanks, everybody.
Thank you.
Obviously, Donna, any questions, I'm more than happy to assist you and the boards.
I know, I appreciate it.
Okay, have a good night all.
Thank you. You too.
Hi, Dan. Thank you.
Thanks, Dan.
So,
Okay.
Dave,
I'm gonna stop.
before you even get into it, of course, I have a question before you get deep into it. On March 1st, the federal court ruled the CTA unconstitutional.
I'll talk about it.
You're going to get to it. Okay.
Yeah, absolutely. Absolutely. I'll just tell you a quick funny story. I did a webinar for all the attorneys in our firm about the Corporate Transparency Act. Was it yesterday? No, it was Monday. Monday at 9:30. Over the weekend, as we were preparing for this webinar, the news came out that this Alabama court had declared the the Corporate Transparency Act to be beyond the constitutional powers of Congress. Now, the question that immediately arose is, well, what does that mean in terms of the impact to people who weren't part of the litigation? Now, the administrative agency who deals with this, their name is FinCEN, Financial Crimes Enforcement Network. They released something yesterday which said the court's decision impacts the plaintiffs in that case. Now, the plaintiffs in that case were a trade group representing small businesses, and they had an individual plaintiff who was one of the members who said, this is impacting me. And it's clear that they were forum shopping. What I mean by forum shopping is they were looking for a court, because they had members all over the country. They were looking for a member who would be impacted by this law, who was in a state where they thought the federal court would be sympathetic to their position. So they got the ruling that they wanted. That ruling is going to be appealed to the Court of Appeals by the United States government. And what FinCEN has said, I'm sure with the U.S. Attorney General's office supporting this, it only applies to the parties in that case. That means only the people who were members of the trade organization as of March 1st of this year. So you can't go join that trade organization now and say, oh, I'm exempt. No, that's not going to work. And the individual plaintiff who was in that case. So for all intents and purposes, it has no impact on us. Now, could ultimately this case go all the way up to the U.S. Supreme Court? Could the U.S. Supreme Court rule this statute to be unconstitutional? Well, of course, that's possible. That's what we have courts for. But I would not take too much out of the fact that a federal district court in Alabama ruled against it to mean that that's necessarily going to mean the death of this statute. And in fact, I read the opinion. I read the whole, I don't know, it was 44 or 54 pages. The judge even said, well, here's how you could fix the statute so it would be constitutional. So even if it's ultimately held to be unconstitutional, there's some very easy things Congress could do to make it constitutional. So let's continue forward as if this law is going to apply to us, because I think there's a good chance it will. And let's talk about why it was adopted by the federal government and what it actually means. So back in 2022, I think it was like January 1, 2022. So it was really, they really went through this law in 2021. They decided that there was too many instances of small companies who were either funding terrorist organizations, involved in money laundering, or were evading taxes. Now, do I think the community associations fall into any of those buckets? No, I clearly do not. And we'll talk about in a minute what the efforts are by the Community Associations Institute to get community associations out of this law. I think that what they were really looking for, where you have limited liability companies who are covered by this statute, buy these multi-million-dollar penthouses in New York City high-rises or other areas of the country. And what they're really doing is they may be foreign nationals who are getting money out of their country. They're getting it into this country. It may be ill-gotten money to begin with, and they're using this to launder that money, that investment. And you know, the government knows that some of the funding of terrorist organizations comes from these small companies that, you know, attract money. Sometimes they might attract it from a country in the Middle East, and then they may fund terrorists in our own country. So they wanted to get a grip on those kinds of evildoers who were doing that. So what does the law actually require? Because there's been all of this, you know, uproar about what the law requires. Essentially, it requires that any corporation that existed prior to January 1, 2024, and that's all of you, must file a report with FinCEN. Okay, now that report can be done online. There's two ways to do the report. One is you download this PDF form that has places where you can just fill in. It's made to be a fillable PDF. You fill in the information, you go back to the FinCEN site and you upload it to the FinCEN site, or you do all the work right online. Now, what's the work? As far as the corporation, they want the name of the actual legal name of the corporation. They want any alternate name that the corporation may use. They want the address of the corporation. Then they go to the next tab on the FinCEN site, calls for reporting by the beneficial owners. Now, you may all say to yourselves, well, I'm a board member. I don't own parts of the association. I don't own the common elements other than my own share of the common elements because I have a deed to a unit. But why would I be a beneficial owner? Well, FinCEN defined beneficial owners as being anyone who has substantial influence over major decisions by the corporation. What are major decisions? Creating a budget, FinCEN describes as a major function. Borrowing money, hiring or firing major contractors for major work. All of these things make it expressly clear that board members are beneficial owners. Now, you can also have a beneficial owner who's not a board member who owns 25% of the units in a condominium. I don't think you have any sections that are even approaching anything like that. But occasionally we do see that in some associations where one investor, even if they're using different affiliated entities, is acquiring enough units that they might reach that 25% mark. I'm going to assume that we don't have that kind of situation in any of the sections here. So really what we're just talking about are your board members. And by the way, management companies are generally not considered to be having substantial influence because FinCEN says to have substantial influence, your rights can't be contractual. So, somebody like Taylor Management might advise a board about what they think the best practice is, but their rights are contractual. So they only do that because they have a contract to do that. FinCEN says that is not a beneficial owner. So really the only people who have to file are the board members. Now, basically there's 4 or 5 pieces of information that each board member would have to provide. 1, their full legal name. 2, their residential address. 3, the identification number on a issued government ID, most typically a driver's license or a passport. Now, there may be other forms of government ID that would suffice, but it has to be some form of government ID. Again, the most common being a license or a passport. And then you have to either scan or do a photo of that ID, of that passport or license, and you have to upload it to the FinCEN site. That applies to each board member. And then you submit that to FinCEN. Now, the only time you have to go back and do that again is to update it if you have a change in the board. So let's say a board member resigns and you have a new board member who you appoint. Within 30 days, you have to update the report, just as to the one new board member, and taking off the one board member who no longer is considered a beneficial owner. We don't recommend you even start to think about this until you've had your annual election. And even then, when are your annual meetings, Donna? When do the sections have their annual meetings?
In May.
Okay. Even then, we'd suggest waiting a little while, maybe to the 3rd quarter, which starts, in July 1, because the law might be determined to be unconstitutional. In addition, although I don't think that's a likely outcome, in addition, CAI National is working to either get a delay in the implementation of the law. Now, the House of Representatives already passed a bill last November by a vote of 400 to 1 to delay implementation of the Corporate Transparency Act for 1 year. There's a bill sitting in the Senate right now that would do the same thing. It hasn't been voted on yet. CAI is trying to get the Senate to move on that. And maybe because of this court case, maybe the Senate says, well, you know what? Why don't we delay it for a year until things kind of filter out and we see what really happens in the court case? That would make some sense to do. So there's some, positive argument for that. The third thing CAI is trying to do is get an exemption for community associations. Now, if you were a tax exempt organization, you wouldn't have to comply. Now, you're nonprofits. You're not tax exempt. Those are two different things. You still have to file tax returns every year. And if you have non-membership income, let's say you're earning interest on your reserve accounts, if you don't have offsetting losses against that income, you would have to pay tax on that non-membership income. So, we know you're a taxable entity. There are very few associations that fall into 501c4 under the IRS code. 501c3s are your typical charitable organization. The American Heart Association, Cancer Association, those kind of entities, maybe a church that you contribute to would fall under a 501c3. Although I think there's a separate number for religious organizations. 501c4s can be communities who allow part of their property to be used for public purposes, but who don't use their assessment money to maintain or repair the homes of the individual members. So condominiums would never be capable of being a 501c4. I have one association that's a large homeowners association that does have facilities that are open to the public, recreational facilities that are open to the public. They did qualify many years ago as a 501c4, but that's not going to apply here. So I will say the burden in terms of completing the documentation is not significant. Now, people do ask, well, who has access to that information? And the answer is only the government has access. So could other governmental agencies get access to that information? Yes, they could. Can an outsider like a bank get access to that information? No. Could a third party outside of, a lending institution get access? No. Now, of course, we all hear about, websites being hacked and all that sort of thing. So is it possible? I'm never going to say it's impossible in today's world, but certainly the government is not intending to make that information available to anybody outside the government. I have already indicated to Donna that as we go into election season, when we go out for the call for candidates, we're going to want to let them know that they have to, if they're elected, they're going to have to comply with the Corporate Transparency Act. What happens if somebody doesn't want to comply? They refuse to comply. Well, I would tell a client that they then have to be off the board. They can't be a board member and refuse to comply because they're subjecting the corporation, the association, to penalties under the Act. Now, the Act both has penalties for the corporation itself and for individuals who either lie or don't cooperate. Those penalties can include up to $500 a day for each violation, up to a maximum of $10,000, and imprisonment for up to 2 years. Now, do I think that the government is going to look to imprison somebody who just didn't cooperate, but isn't involved in any of the purposes that the bill was adopted for, like money laundering, funding terrorist organizations, or not paying taxes? No, I don't think they're going to look to imprison anybody. But I think if somebody was involved in those kind of activities and they didn't file to avoid detection, I think the government might well use the criminal penalties.
Now, Dave,
So, go ahead.
can we back up a second? Because you were talking about the 501(c)(3)s. So we
Yep.
have two questions. One is, what about the golf course? It's open to the public. And the other one says the same thing. The golf course is a public operating at a loss. Can we use that to offset?
Yeah, first of all, the golf course is on a fee basis. It's not just open to the public. You have to pay to use the golf course, so that's not eliminating. And the individual condominium associations don't own the golf course, so that wouldn't get them out of this. It'd have to be your common elements that would be devoted to a public use. Another exception, but it wouldn't apply to any of you. Again, it's meant to be aimed at small businesses. So businesses that have more than 20 employees and more than $5 million a year in revenue, not in profit, but just revenue, are also exempt. But even CCA doesn't meet that criteria. So even CCA would not be exempt under that part of the law. So, none of the exemptions are going to get any of the Clearbook section associations out of compliance with the law. But as I said before, we're not in a huge rush. We can wait to July, August, September, before we even start thinking about filing and see where we are 6 months from now in terms of where are we with the cases and where are we with these statutes that I've been talking about, maybe delaying implementation. We can certainly wait it out till that point in time.
Now, Dave, can you explain if an individual does submit their identification and their information, how often does that have to be done? Is it yearly?
No, once, unless they're no longer on the board and another board member comes in, we would take out that one person and put in the other person. This is not an annual filing. Once you filed and you said these are our beneficial owners, for a lot of companies where you don't elect board members every year, that information is going to stay relevant for 10, 15, 20 years. So the statute doesn't require refiling every year.
Now, if you move from one section to another, would that, since it's a different corporation, you'd have to file again?
If you were still a board member?
Yes.
You were board member in one and you became a board member in another, yes, you would have to file again because it's a different reporting company.
Okay.
So yes.
And then if there's not 100, if there isn't 100% participation by a section board other than the non-filing individuals being subjected to a fine and possible imprisonment, is the section board as a whole liable in any way?
Well, the corporation is. So the person who does the filing has to attest to the fact that you've named all the beneficial owners. Who is going to do that filing for anybody if all the board members aren't giving them their information? You can't do that because the person who's doing the filing would be lying to the federal government. That in and of itself would invoke the possibility of personal liability. So that's why I said earlier, if you had people who were not willing to cooperate in this process, they have to get off the board. They have to be removed. There's just no way because they're violating federal law.
Now, if you sit on more than one board, I do believe you answered this, but like the CCA board and the section board, you'd have to file twice.
Yeah, your information would have to, same information, okay, as a beneficial owner, it's the exact same information, but that information would have to be filed on 2 occasions, yes.
Okay. And someone else said, I thought if your government ID number changes, you would need to refile.
Well, let's say, yeah, I mean, look, if information you previously provided is no longer valid, let's say you put a driver's license, it has to be a current active driver's license. Let's say you decide to stop driving and you don't renew your driver's license. Well, then you'd have to put in the currently, some other government ID, okay, to indicate, to meet the requirements of the statute. If your passport expired, and I think passports are good for 10 years. If your passport expired that you used to register, then you just make that one change to your filing and update that particular piece of information.
Okay. Does anybody else have any other questions? Please put it in the Q&A or the chat. Is there any specific board member responsible for filing? And then when do we have to file?
No, but it does say that the chief executive officer, which I would take to typically be the president of the association, has a personal responsibility to make sure that the filing is done.
Okay.
Now, I will tell you that FinCEN has done a pretty good job of having a very user-friendly website. And I am telling clients that if they wanted to do this themselves, they could. We could provide you with the information as to where this can be done. If people don't feel comfortable doing it, and I don't know, Donna, if Taylor's going to undertake any of this or not.
The CCA board, and we are still talking about how this is how we can help the sections get it all done and make sure that everyone's in compliance.
I mean, we can do it. We can do it. I'm just telling people that it isn't necessary for an attorney or an accountant or somebody of that nature to do it. It's not a requirement that it be done by a professional. It can be. There's even services out there. Now, I don't know how good or bad they are. There's been a cottage industry that has popped up, not surprisingly, on the web that says, oh, just give us all the information and we'll file it for you. Well, frankly, if you're going to put all that information on their website, you might as well go to FinCEN's website and give all that information to FinCEN. It makes no sense to go to a third party and still have to fill in all that information. But if we did it, we'd ask you for the exact same information. We'd say, okay, here's a form. You have to fill out all of this information. Again, basically 4 items of information, and you have to give us a picture or a scan of whatever government issued ID you were using so that we could, upload it for you.
Okay. Specifically, who is the keeper of the information?
FinCEN, the Financial Crimes Enforcement Network.
Okay. Any other questions?
If there's questions afterwards, I guess route them through Donna. That way, if, we get questions, and it's an answer we think would be generally applicable to everybody, an email can be sent out with the answer to the question.
We have one more. Has anyone vetted or been vetted? Maybe she's asking.
I don't know what vetted means in this regard. FinCEN is not going to reject anybody, as this is not like an application where they say, oh yeah, you're capable of being a board member. That's not what this is about. This is simply a depository of information so that if FinCEN or some other governmental agency became aware that you're possibly involved in some illicit activity, they could immediately determine who the beneficial owners of that entity are. But they're not vetting you. They're not vetting you. Now, how would they know that you're a corporation? If that's the question, how would they know you're a corporation is supposed to file? We're assuming that since every LLC and corporation that's not exempted has to file with the state. So whether you're an LLC or you're a nonprofit corporation, you're created through a filing with the state of New Jersey. I'm pretty sure what FinCEN is going to be doing is cross-checking that list of filings in the state of New Jersey, and then using a computer to cross-check that against who did the filing as of January 1 of this coming year, assuming the law isn't delayed. And anybody who doesn't will probably get a notice at first saying, hey, we didn't get anything from you. What's going on? Why didn't you file? And, it does say that you're only subject to penalties if you willfully violate. Willfully means you knew you were supposed to, but didn't. Well, everybody on this call now knows they're supposed to. So if you didn't, you'd be willfully violating, although this is an attorney-client privileged communication. But I don't expect FinCEN to come down hard on people immediately, but I think there is a way that they're going to be able to figure out what all these corporations and entities are. I mean, there's at least tens of thousands of them, and maybe even hundreds of thousands. I think the projection might even be north of 1 million organizations that are going to be required to file under this act. So there's a lot. There's a lot.
Has anyone vetted the depository company?
If that question is going to their website and how secure the website is, look, I'm not going to give you any guarantees about governmental websites. We've seen them hacked before. I will say that, another large governmental website was the one that was set up for the Healthcare Act. As far as I know, that's never been hacked into. I don't think the Treasury Department, and by the way, FinCEN is under the Treasury Department. I don't think the tax information, which would be the most valuable to people in terms of Social Security numbers, et cetera, has ever been hacked into. I would assume the government's doing a pretty reasonable job, but we know that's a constant fight between cybersecurity and keeping things safe. So I would never say never, but I would say that there's probably as much security there as could reasonably be expected.
And if we do nothing wrong, we need not fear this. That was a question.
That's right. I mean, if you're not involved in any of the target illicit activity, there's nothing to fear. And I can't imagine, frankly, I can't imagine that any of the community associations my firm represents would be involved in any of the type of illicit activity that this law was looking to clamp down on. So no, there's nothing to fear. This is not the government coming knocking at your door saying, oh, you're keeping a gun you have no permit for. That's not what this is about. It's for those three categories that I already mentioned. So we shouldn't be becoming paranoid about it.
What happens to the information when you leave the board?
Well, you should have yourself then taken off as a beneficial owner. Now, is that information still floating around somewhere within FinCEN's site? I'm not going to guarantee you it's not. But you're off now as a beneficial owner. And presumably there's somebody who's taken your place who now would be on as a beneficial owner. And that's really the focus, is who are the beneficial owners.
What value added does this provide the government?
The ability to track down and hold responsible people who do the things that the statute is looking to avoid. As I said earlier, just one example where you have these LLCs who are foreign LLCs. They might form a United States LLC, but they're foreigners. You can't see by going on, you don't have to file the names of a limited liability company or an LLC. You don't have to file the names of the people who are controlling that LLC. So you would otherwise never know who controls that LLC. But that LLC could own, incredible amounts of assets. Now, remember, it's the $5 million is revenues. It's not assets. You could own $100 million worth of assets and still have to file because you don't have revenues of more than $5 million a year plus 20 employees. So, yeah, go ahead.
What if you don't drive and don't have a passport?
I knew that question was going to come up, and it's a good question. It's a very good question, and I know that that's going to happen in some age-restricted communities. And if you have no other governmental ID, I think we'd have to go to FinCEN has a hotline, and I think we'd have to go to FinCEN's hotline and say, hey, we have people who are 83 years old. They're not driving. They no longer have a passport. What do you want from them to validate their identity? You're going to have to, they're going to have to come up with something for people that are in that circumstance, but I don't know what it is yet.
Okay. There's one more. If the section has unit owners who declare as LLCs, do they have to file?
Not unless they own 25% of your units.
Which I don't think we have any single investor that owns that much.
Right.
In one section.
It have to be in one section. They have to be in one section. Yeah. Yeah.
Okay. Are there any other questions?
By the way, that LLC might have to file for other reasons. Okay. Not as part of our filing, but if they own units that they rent, they come under the definition. I should make that clear. They come under the definition of a small business. they're going to have to file. Whether they know it or not, I don't know, but they're supposed to file as well. Just not, it's not part of our obligation.
And Dave, is it 25%, right?
Correct. Correct. There has to be an ownership interest, either an ownership interest equal to 25% or more, or substantial influence over those major corporate activities that I mentioned. Not both,
Okay.
either or.
Either or. Oh, well, they're coming in. Okay, I think you're good.
All right. No more questions?
It doesn't look like it. If anybody has questions, please email them to me. If I don't know the answer, Dave will give it to me and I will respond to you quickly. Everybody says thank you.
Okay. Well, they're more than welcome, and I'm glad you participated. Thank you, everybody. Have a
Thank
wonderful
Thank you, Dave.
Thank you very much.
good night now.
Good
Good
night.
night.